and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 7th of August 2023, and here are the questions we will be answering today.
How will the laptop import curbs affect India? What are the gaps in the data protection bill? Is the street too euphoric on laptop import curbs? How will 28% GST in online gaming work?
Laptops, tablets, and personal computers have joined the list of products that need a license to enter India. While the government did not cite any reason for last week's surprise move, experts believe it was done to nudge companies like Apple, Samsung, and Dell to make in India. And it came days after the PLI scheme for hardware failed to find any taker. So, in today's first segment, Bhaskar Kumar explores the likely impact of restrictions on laptop imports. Here is what he found.
Citing security risks, the government imposed import restrictions on laptops, tablets, personal computers, and similar data processing units on August 3rd. While China was not mentioned, the restrictions will mean that going ahead, such items can be sourced only from trusted partners via a licensing regime. Late on August 4th night, the government deferred the implementation of the restrictions on imports of laptops, PCs, and tablets by 3 months to November 1st. Even so, news agency Bloomberg reported earlier in the day that global PC and laptop makers were already in talks with the center on how to obtain the required licenses. Issued by the Directorate General of Foreign Trade, or DGFT, the original notice had clarified that airline passengers returning to India could still carry such items purchased abroad. An exemption would also apply to such items being purchased from e-commerce portals, by post or courier. An exemption from the import licensing norm had been granted for up to 20 items per consignment intended for research and development, testing, benchmarking, evaluation, repair, re-export, and product development. The licensing requirement would also not apply if the items formed an essential part of a capital good. Curbing excessive imports of electronic items appears to be the other motive. In FY23, India imported $8.8 billion worth of the 7 items now under the licensing regime. Out of that, China accounted for products worth $5.1 billion, or 58% of the total amount. Of these items, when it comes specifically to personal computers and laptops, India's imports from China actually fell 23% in FY23 to $4.1 billion, compared to about $5.3 billion in FY22. However, this drop came after a sharp jump in such imports from China in FY22 and FY21. Overall, about 65% of the units that make up India's total laptop and PC market are imported. Industry players have reportedly said that this decision will boost local manufacturing of these devices. Optimus Electronics, an electronic manufacturing services company, hailed the decision as progressive and said it would lead to an expansion in its manufacturing capacity. On July 31st, Reliance Retail also unveiled the JioBook, a 4G LTE-powered laptop priced at 16,499 rupees. However, one industry expert did warn that the restriction could lead to short-term supply disruptions for brands like Apple, HP, and Lenovo. Also on July 31st, the government extended the deadline to apply for benefits under the Modified Production-Linked Incentive Scheme for IT hardware products till August 30th. In May, the scheme's budgetary outlay was more than doubled to 17,000 crore rupees. So, will the curb on PC and laptop imports boost local manufacturing?
I see it as a carrot and stick, exactly what played out for the mobile phone industry, which means that you put a tariff measure in that case in the mobile. From zero, we took a 20% import duty and we gave them a PLI. So you tell them, if you want to do business in this country, you're welcome to come and start making in this country. And while you make in this country, we will incentivize you because we do understand that there are certain disabilities compared to global competitive levels. So it worked out for mobile. I think we are playing from the same playbook now, where the IT hardware has been given an incentive as PLI. And on the other side, of course, we are bound by ITA1, and we cannot put a tariff on laptops or the IT hardware. And hence, at least in my opinion, a non-tariff measure has been put in, which is to basically license the import. While this will increase the assembly of IT hardware, it may not completely solve the component issue that we have, for which I think we are waiting for a PLI 3.0.
This will certainly boost domestic manufacturing of laptops and other such items in the longer term. In the longer term, when I say 6 months to 1 year down the line, the assembly lines will be modified and we should be able to get good volumes out of assembled in India for the laptops as well. So I think it's a fair concern from an import substitution point of view, but the only defense from the government's point of view can be that we have a rather mature ecosystem in place, at least for minimal value adding, which we're doing for the assembly or the make in India for the smartphone space. We already, most of the vendors, most of the brands are already assembling a lot of desktops already in India. I don't think it should be a problem. We already have some systems in place.
India's IT services and tech industry, which was set to become a $245 billion sector in FY23, owes a lot to the easy availability of imported computing hardware for decades. How will this sector be affected?
I remember comments made by Narayan Murthy, I think it was, the founder, the lead founder of Infosys, many years ago, who, when he was asked about the rise of the software industry, attributed it to import licensing going away for computers. And that's really what enabled the industry to thrive. Now, I'm sure people will say, well, this is now, software will be an exception. But will it really be an exception? It might be an exception if your name is Infosys or TCS or Wipro. But will it be an exception for the small 5-member startup trying to establish a new software venture? Or will that somehow need an additional carve-out and exception? I really think this is a terribly retrograde step. It's one that we should reverse. It's not in the national interest.
The end of the license Raj began in 1991 with the onset of economic liberalization. But some believe this move has the ring of that bygone era.
It takes us back to the bad old days, I'll say, of the license regime. We have provisions that have been at least announced in the press that say that we will go to trusted partners. Now, who are trusted partners? Make it transparent. Second, and there should be no discretion involved in someone saying so-and-so is trusted, so-and-so is not. Second, we have a whole set of exceptions that have been announced. All of these exceptions are the kind of thing that we had gone away from over 30 years ago when we scrapped import licensing. I think it's too bad that we're going back in time to an import license regime for so vital an item that so underlies the way in which we work in the modern economy.
While the domestic industry believes that this decision will provide a fillip to local production of laptops and PCs, it may be worth asking whether the only way to do this is by opting for a move that brings back memories of the licensing regime of yesteryear.
Another government move that had been in the news for a while is the tabling of the Data Protection Bill in Parliament. The revised draft comes with some changes and it retains some provisions which privacy experts had red flagged. So what are the key takeaways in the new avatar of the long-awaited Data Protection Bill? And are there any gaps? Ayush Mishra dives into details to bring you the answers.
Union Communications, Electronics and Information Technology Minister Ashwini Vaishnav tabled the Digital Personal Data Protection Bill 2023 in the Lok Sabha on August 3rd last week. It has been long in the making. The origins of the bill can be traced back to 2018 when Justice B.N. Sri Krishna panel helped formulate the initial draft. The bill was tabled in Parliament in 2019 but was subsequently referred to the Joint Parliamentary Committee or JPC, which tabled its report in December 2021. The bill was tabled again, but in August last year, the government again withdrew the bill from Parliament to accommodate changes. And after several modifications, it has now been tabled again.
This regime or this environment of big companies and small companies, technology companies, essentially creating business models by misusing and exploiting digital personal data of citizens is something that this bill intends to address.
This bill seeks to provide protection for personal data and the privacy of individuals. This bill establishes requirements, businesses handling and data processing, as well as individual rights. Its purpose is to prohibit cross-border data transfers, penalize firms for data breaches, and provide a framework for the establishment of a data protection body to ensure compliance.
DPDP bill, the way it stands today, is quite a milestone in establishing digital security and data security for data principles in India. And the reason I say that is because this is really the first time that there will be a law that gives very meaningful and comprehensive rights to data principles. So under this law, as a data principal, I have a right to know who has my data, what are they doing with my data, what sort of processing is happening with my data. I will have the ability to ask, data fiduciaries who are processing my data to delete my data under certain circumstances. I also have a meaningful set of remedies.
The law, it's one of its kind for specifically for India. We've had laws with respect to Indian IT Act of 2000, which got its amendments in 2011 and subsequent rules across different sectors. But this one encompasses all the sectors. It will be applicable across and it will complement the local and the regulatory laws that exist. For example, regulations from RBI, regulations of DOT. It will complement those, and it would act as an umbrella law so that personal data is protected.
Digital platforms will need to take unconditional and informed consent from users for processing their data, and users will be able to withdraw this consent at any point post which the platforms must stop processing their data and erase it. Personal data can be transferred to any country except certain geographies that the government may blacklist going ahead. Bill has serious provisions for the way private entities can deal with users' personal data. Many of those yardsticks do not apply to the center itself, which enjoys wide-ranging exemptions and power over the enforcement process.
The government of India is one of the biggest collectors and processors of personal data, whether it's in the form of Aadhaar or any other government scheme. And with this exemption, any government entity can be exempted from the applicability of the bill, and indirectly also they would not be liable in case there is a data breach. So that's a big concern. And also the fact that, if entities are processing this data, these entities could be also the biggest collectors of personal data in the world, just by the sheer size of the population of India. And in that sense, it kind of defeats the very purpose of the bill.
The bill proposes amending Section 81J of the Right to Information Act 2005. Currently, this section prevents a public authority from sharing anyone's personal information on two main grounds: that the disclosure will have no bearing on any public activity, and that revealing such information would cause unwarranted invasion of the privacy of an individual. unless such disclosure is justified in larger public interest. However, the bill tabled in Parliament proposes that the personal information of government officials will not be disclosed under the RTI Act.
Most importantly, there is this Right to Information Act, which the provisions are being diluted. And this is also important from the fact that, again, there are amendments being proposed in that legislation where government entities can refuse to give data on the right to information request, claiming provisions of the Digital Personal Data Protection Bill if they feel that it's not necessary or required, and if it breaches the privacy. So again, it gives a very broad scope in terms of and a broad excuse to the government to avoid giving replies to the right to information, the Right to Information Act, and it kind of defeats the purpose of that legislation as well.
The Digital Personal Data Protection Bill is a significant step towards safeguarding privacy, but it has notable gaps. The bill grants exemptions to the government, raising transparency concerns, and proposes limiting disclosure of public officials' data under the RTI Act, potentially affecting accountability. Addressing these issues is vital for creating an effective and fair data protection framework.
Data protection is a common thread that runs through both the government moves, the tabling of Data Protection Bill and import curbs on laptops and personal computers. While global players are apparently not happy, there has been a euphoric rally on the bourses in shares of local manufacturers of related items. But analysts advise investors to wait and watch before jumping the gun. Harshita Singh brings you more details.
The government last week curbed imports of laptops, tablets, personal computers across 7 categories, firming up its domestic manufacturing push. In FY23, India imported $8.8 billion of these 7 items brought under the licensing regime, out of which 58% worth of products were sourced from China. At the bourses, the move has led to a massive rally in stocks of local electronics manufacturers. Shares of Dixon Tech, Optimus Infracom, Netweb Tech, and HCL Infosystems surged up to 30% over the past 2 days. In comparison, the Sensex benchmark index was flat. The euphoria comes as the import curbs could benefit the local laptop and computer manufacturers which compete with global giants like HP, Samsung, LG, and Lenovo. Analysts, however, say investors should not jump the gun and let more clarity emerge on the expected benefit of the move.
This may have a positive impact over a longer period of time, because as PLI schemes get unrolled and as government focuses more on Make in India and Made in India, and more incentives are passed on to the respective sectors in the respective category, those companies will tend to benefit over a longer period of time. But it will not translate into immediate any major positives for the companies which are associated with these sectors. In terms of numbers, there's not much information available in public domain as to how much benefit will these companies get in terms of whatever restrictions the government has put in place. So it's very difficult to zero down on on the number front that will benefit these companies. At the same time, I think in stock market, it is always better to let the dust settle down and then possibly take a call whether you want to buy, hold, or sell a particular stock in this category. So, let things settle down and let there be more clarity.
In the June quarter, electronics emerged as India's 4th largest exported item, overtaking chemicals, drugs, and pharmaceuticals. This was led by mobile phones on the back of the PLI scheme of 2020. Now, players such as Dixon Tech and Optimus are looking to benefit from the IT hardware PLI scheme. The recent bumper listings of NetWeb Tech, Cient DLM, and IKEO Lighting also signal growing traction for the Electronics Manufacturing Services or EMS theme. But the stocks in this space command lofty valuations. The EMS theme is an attractive long-term investment option, but the recent high valuations of the stocks could be a concern, and conservative investors may prefer to wait for a meaningful correction, says Santosh Meena of Swastika Investmart, whose top picks include Dixon Tech, Surma, and Cient DLM. Dixon Tech, Optimus, NetWeb, and Surma are trading at PE multiples of 55 to 138 times their 12-month trailing EPS. Thus, it remains prudent that investors take a cautious approach to stock picking in this space. Today, on July 7, Dalal Street will react to the Q1 earnings of Bank of Baroda, Balakrishna Industries, Morpin Labs, and Usha Mart, among others.
He's making plans for an early retirement. Business Standard.
Stocks of most online gaming companies, meanwhile, are still reeling under the shock due to the government's move to levy 28% GST on face value of the bets. But most of us are still trying to get head around the taxations in the sector. Raghav Agarwal decodes it for you.
Before the GST Council's decision, the online gaming industry had to shell out an 18% tax on gross gaming revenue or GGR. GGR is the difference between the money wagered by the players and the amount paid out as winnings. Let us consider a scenario where 5 players each had put in 1,000 rupees for a game. The total wagered amount is 5,000 rupees. Out of this, suppose 2,000 rupees were given out in the form of winnings to the players. Then the company had to pay 18% GST on 3,000 rupees, which amounts to 540 rupees. From the player's perspective, they have to pay an 18% tax on the platform fee. The company charges this fee when the players place a bet. In the above case, suppose a platform charges 10% of the wagered amount as the fee, so the player was liable to pay 180 rupees as a tax on the platform fee. However, the new norms have shifted the tax burden to the customers. Now, a 28% tax will have to be paid on the amount deposited by the player in a game. Suppose a player puts in 1,000 rupees in a game, he or she will have to pay a GST of 28% amounting to 280 rupees. Additionally, they will be charged a platform fee by the company. This varies across the platforms. Here we will assume that the platform fee is 10% amounting to 100 rupees. Till now, the player's liability on a deposit of 1,000 rupees is 380 rupees. Now, there can be two scenarios. If a player loses, he will have to forego the entire amount in addition to the taxes paid. If a player wins, say 2,000 rupees, he will have to shell out another 30% as tax deducted at source or TDS. This will be 600 rupees. So even if a player wins 2,000 rupees on an initial deposit of 1,000 rupees, his total liability will be 980 rupees, assuming the platform fee is 10%. This is considerably higher than the previous rule where they were supposed to pay only 18% tax on platform fees, which is 18 rupees in this case. Let us first assume that a player wins. Under the old rules, their liability, including the platform fee, was 100 rupees platform fee plus 18 rupees as tax plus 600 rupees on winnings, totaling 718 rupees. Under the new norms, the player's liability will be 280 rupees as GST plus 100 rupees as platform fee plus 600 rupees as the tax on winnings. The total will be 980 rupees. Moreover, if a player loses in the old norms, their liability would be 100 rupees as a platform fee and 18 rupees tax on it, totaling 118 rupees. In the new rules, it would be 280 rupees as GST plus 100 rupees as platform fee, taking the total to 380 rupees. Under the previous announcement of the GST Council, the players were also asked to pay 28% GST on the winnings. It would have meant that in the above case, when the winnings were 2,000 rupees, if the players decided to bet the money again, they would have been liable for GST on it. This would have meant that on top of the tax liability of 980 rupees, another 560 rupees would have to be paid by the player just to bring the money back into the game. This clause of repeated taxation has now been done away with. The platforms will have to pay 28% GST on the face value of the bet. So, in the above case, they will be required to pay 280 rupees on a bet of 1000 rupees. Moreover, several experts have said that such a heavy tax burden on the players will discourage them from playing real money games. Also, the companies cannot save the levy even if they shift their base outside India, as the GST Council has decided to bring in registration requirements for discharging GST in India.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In the United States, 30% tax is imposed on any winnings through online gaming. In the EU, the tax on winning varies between 15 to 20% depending on the member state. Well, that's all for today. For more news, views and analysis, please log into business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.